Ignore the noise. Look at the heat map. 159.64. Everyone is staring at 160, waiting for the breakout to mint new millionaires or for the Bank of Japan to smash the price into oblivion. But here is the counterintuitive fact. The highest volume node is sitting empty just above 159.57. The herd has already bought the breakout, or they are shorting the ghost. There is one danger zone, the liquidity void above 159.60, and one hidden opportunity that the yield spread is screaming about. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, including an aggressive short that nobody is talking about. The session bias is a bullish trend continuation, but we are structurally fading the intraday extremes. We are in a parabolic flag on the hourly, grinding higher, yet we are right below a level that triggers an intervention panic attack. Write this number down. 159.15. This is your line in the sand. If we break below 159.15 today, the entire 4H bullish structure resets into a mean reversion trap, potentially targeting the 158.63 pivot. Until then, the path of least resistance is a liquidity sweep above 159.57. Here is the micro insight about positioning. The fast money is long, heavily long. They are reading the same strong buy signals on the daily and the weekly. But the smart money is selling volatility. The skew tells us that demand for topside yen puts is actually dipping, meaning the herd is capitulating on the intervention hedge. That complacency is exactly why the trapdoor opens. Let's frame the chart from the top down. The weekly trend is a brute force strong buy. We are miles above the 200-week moving average, which is acting as a gravity line way down at 155.33, a level we haven't even glanced at. The 100-day moving average is sloping so steeply at 157.70 that any dip towards it would be a violent buying opportunity for algorithms. But look closely at the daily structure. We are clipping along the 20-day moving average at 158.63 like it's a jetpack. As long as we hover above this 158.63 level on a closing basis, this isn't a topping pattern. It's a consolidation before the rip. Now drop down to the 4-hour chart. This is where the trap is being set. The 60-period moving average is sitting at a key anchor point. We are seeing price action create higher highs, but look at the MACD. The histogram is compressing. We have a textbook hidden negative divergence forming. In plain language, momentum is exhausted. Buyers are stepping in, but they are pushing with less and less force. This usually doesn't break the trend immediately. It invites a liquidity grab. It lures the breakout traders above 159.60 to grab their stops before the actual fatigue sets in. The 1-hour chart gives us the scalping map. The 5-period EMA at 159.40 is our short-term equilibrium. Right below that, the 10-period EMA at 159.24 acts as the first line of defense for the intraday bullish structure. The RSI at 59 is not overbought, which is dangerous. It means there is plenty of room to run before we hit a technical ceiling. Here is what most traders miss. The volume gap above 159.57 isn't resistance. It's a magnet. Price hates voids. It will try to fill it. Today's critical resistance is a band, 159.51 to 159.57. A 1-hour candle close above that 159.57 high-frequency barrier opens the door to the psychological magnet at 160.00 instantly. The fundamental engine behind this grind is the yield differential drama. We have a policymaker from the BOJ out today saying that Japan risks a return to stagnation if they hike too early. Yet they warn stagnation will hit if they don't hike at all. This is a central bank trapped in a hall of mirrors. The market interprets this paralysis as a green light to short the yen. The headline literally says, "The yen braces for new storm." We are not fighting the Fed here. We are fighting the absence of the BOJ. The US 10-year yield is the puppet master. As long as risk assets are in a melt-up mode, the yen is the funding currency. Watch the S&P 500. If you're trading US dollar to Japanese yen, you are trading the S&P E-minis. They are tick-for-tick correlated right now. A risk-on surge in equities overnight will blow the pair through 160 regardless of the intervention ghost. My 1 to 2 week directional lean remains aggressively long on any dip that respects the 157.70 level. The only event that invalidates this bullish outlook is a sudden, pre-market check. If we break below that 200 period moving average on the 4H, the trend is dead. Do you think the dollar breaks 105 on the DXY this week? Comment yes or no below. I'm tracking the consensus to see if we get a US dollar pullback that finally gives us a clean dip buying entry on this pair. Most people skip this section. They watch the analysis but freeze when it's time to execute. That's exactly where the money is made. Keep watching. Strategy 1 is the sniper, the conservative play. We are waiting for the breakout confirmation. The exact trigger condition is a 1-hour candle close above 159.57. We do not want a wick. We want body acceptance above the high-frequency bar. Once that prints, you enter long immediately. Your stop loss goes at 159.23. That's right below the structural support and the intraday pivot zone. The logic here is simple. If the break above the high fails, we don't want to be in the trade. Target 1 is 159.95, just below the psychological 160 level to avoid the order book cluster. Target 2 is 160.60, the next liquidity target. Your risk-reward on this is roughly 1 to 3.2. This setup is voided if we get a headline from the BOJ's weather speaking unexpectedly. Do not hold through unscheduled speeches. Strategy 1 the sniper, conservative, entry, 159.57, 1H close above, stop loss, 159.23 take profit 1, 159.95 take profit 2, 160.60 risk, reward, 1:3.2 invalidation, void if BOJ speaker emerges. Strategy 2 is the active trader. We playing the moving average bounce. The entry condition is a pullback to the 159.15 zone. That's exactly where the 1-hour support cluster aligns with your key structural level. We buy the touch of 159.17 with a limit order. Stop placement is at 158.98, clear below the 20-period moving average on the 4H. We don't want to be in this if the market falls back into the previous range. Target 1 is the retest of the highs at 159.55. Once target 1 hits, move your stop to break even. Target 2 is the full breakout target of 159.90. The trailing stop rule here. Once we are 15 pips above target 1, trail the stop manually 10 pips behind the 5-minute 20 EMA. Type your US dollar to Japanese yen range for tomorrow in the comments right now. I'm looking for a number. Is it 159.10 to 159.80? Or are we finally breaking the 160 ceiling? Let's see who's aligned. Strategy 2 the active trader, standard, entry, 159.17, limit order, stop loss, 158.98 take profit 1, 159.55 take profit 2, 159.90 risk, reward, 1:2.8 invalidation, void if 1H candle closes below 158.95. Strategy 3 is the aggressor, the high-risk play. This is the intervention phantom short. We are fading 160.00 without waiting for a rejection candle. The entry is a market sell at 159.95, betting that the order book wall at the figure holds. This is counter trend, extremely dangerous. Stop loss is tight at 160.25. If 160 breaks and the stops are swept, we do not hold and hope. The invalidation is instant. Target 1 is a quick scalp down to 159.57, the exact sniper breakout level, which should act as support on the retracement. Target 2 is 159.20. Only 4. Those who can lose small and manage risk aggressively. Do not size up on this. It's a high-velocity trade. Strategy 3 the aggressor, high risk, entry, 159.95, market sell, stop loss. 160.25 take profit 1. 159.57 take profit 2. 159.20 risk, reward. 1:2.0 are invalidation. Void if 1H close above 160.10. Let's reset the risk dial. Never risk more than 1 to 2% of your account per trade. We have Tankan data and random BOJ whispers on the horizon. No positions through high-impact red folder news. Stops are non-negotiable. The intervention ghost can slice through your account in 30 seconds. This discipline is how you survive to trade the next big directional move. So here is the single most critical level for the next session. 159.15. Below that, the dollar bulls are trapped. Above 159.57, the yen bears are capitulating. You have your 3 precise plays. The wildcard for tomorrow isn't a data print. It's the unofficial jawboning from Tokyo. We expect verbal intervention to get louder, so keep your stops tight if you want the full breakdown on Bitcoin and the S&P 500 divergence I'm tracking, which is directly influencing this pair. That video is live now on the channel. Tap the end screen to catch the volatility forecast for the US Open. Smash the like button if this gave you a clear, executable plan. Subscribe, hit the bell, and I'll see you in the next one, right before the move hits.